All right, I have Joel Farrell from Strive for 25 back today. And today we're going to kind of dig into a little bit about if you're a first-time home buyer or investor and you're going to reach out to a lender or mortgage broker and what is the common mistakes that he sees or what's the best advice he could give someone. So welcome back, Joel.
Thanks again, Mark. Appreciate it. There's a lot to really dig into. Um, at the very, very, very basics, right? Whenever I'm talking to somebody about getting pre-approved to buy a house, it's three things that we're going to look at, and that's income, credit, and then money for down payment and closing assets. And really, each of those three things is going to have some other categories or things to be aware of. And if it's okay, I'll just kind of go down one by one with one thing I think someone needs to be aware
Oh
of.
yeah,
Is that
definitely.
cool?
Yeah. Yeah, of course.
So, you know, I think the biggest thing people talk about is credit, right? Like, hey, my credit score is 800. I should be able to buy a house or whatever, get this thing or that thing. And it's like, okay, credit, to get a loan, we assume you have good credit. That's just like to get into the game. Like that's the assumption, right? But one of the biggest struggles that I see is just the non-congruence with what we use as lenders for credit scores and what's available to the consumer online. Your credit cards are going to give you a score, Credit Karma, Credit Sesame. There's just a bunch of different apps out there. And at the end of the day, there are different algorithms than what we use as a lender. It could be high, it could be low, it could be spot on. It's typically the scores from Credit Karma are going to be higher than what we pull. That's on a majority of the time. So that's the biggest thing is, hey, what are your scores actually? What are they actually? And then as a lender, the minimum score for a lot of programs is going to be 620. Some programs get you down to 580. And so the higher scores, the better the options and more, they're greater the odds of approval. So credit scores, that's one thing. Two, income. Hey, that really is the big driver in terms of what you can qualify for, debt to income ratios. And 45% debt to income ratio is kind of your standard number. There are programs that allow you to go higher than that. So gross monthly income, if you take 45% of that gross income, and if your projected mortgage payment and your other payments on your credit report, like a car payment or credit cards, things like that, if all that's below 45%, cool. I mean, that puts you in a great spot. So that's just something to be aware of. Another thing too is job history, job gaps. Those are other things to be aware of. Job gaps, if they're longer than 30 or 60 days, could be an issue. Self-employed, whole different ball game. You talk to a lender. If you're self-employed, talk to a lender. And then assets. I think the biggest area where people get a little bit confused on is that when you close on a house, you're going to have two pieces of the puzzle that you need money for: down payment and closing costs. And so when someone says, hey, you know what, like I'm going to buy a house for 300K, FHA is 3.5% down. Okay, that's 10,500, I think, something like that. Okay, I'm good to go, right? Well, no, there's also going to be closing costs, and it's a whole nother conversation. So those are just some of the basics, just entry level things to be aware of as you're looking at what it takes to qualify for a loan.
So it seems pretty standard and pretty straightforward, but I'm sure do you see a lot of common mistakes or things when they come to you that it's just there's things that they could have done to maybe improve their chances of having a better credit score or even their income, like how they're reporting it, or just their debt to income ratio like you're saying. But is there like some common mistakes that you see people making?
Yeah, I'm going to kind of start with assets first. The biggest mistake that I see is, hey, everything else is aligned for closing. We're kind of, trying to fit inside this little bitty level or up against the gun on just verifying money to close, down payment and closing costs. And so large deposits can kill a deal at the end. If you don't have the money already in your accounts for closing, if underwriting sees a bank statement and they see deposits coming in, cash deposits, that's going to be a big deal. If it's a large enough cash deposit, we may not be able to use that. If you're getting money that you can't document and source, let's say it's a check or whatnot, and you can't source it, could be an issue, right? Transferring money, all that stuff becomes a paper trail that also can become a nuisance for you in terms of documentation. So, documenting the money for closing is kind of something we have to do. money going in and out of accounts is going to make your life a lot harder. So if you know you're going to buy a house, try to get all your money into one account and leave it there. That's my best advice in that scenario. Now, if that's not possible, cool, but that's just my best advice is just get it in one account. If 2 months go by and then money sits there in terms of billing cycles, any deposits underwriting won't see because they're only going to go back 2 months typically.
Awesome. And is this stuff that you think people are learning in school, like high school?
Oh, hell no. Yeah, I mean, like that last example of, money in your accounts and deposits, like, somebody in school, probably doesn't need to know that at age 18 or 16 or in college. But if you hear it once and then you hear it again and again and again, it's going to sink in. So, I mean, I think it's definitely viable stuff to be talking about.
Yeah, I totally agree. Like for me, even just buying my condo, like I really had no idea what I was really doing. It was kind of just like, bring your paperwork, bring your bank statements, your pay stubs, whatever my credit score was at the time. But I had no idea like what it was all really based off of. It was just, I was just bringing this information they were asking, but I didn't know it was, I mean, I guess somewhat you could say it's kind of like a game, right? There's like ways to improve your scores. And like you're saying, keeping your money all in one account to make it you don't have to not this paper trail where you have to document all this maybe this cash coming in. But I didn't realize like it can affect you quite a bit. Seems like. So do you see a lot of people maybe um, getting turned away because of just simple things that they're not aware of? And it's not really like, it wasn't like their credit score was too low, but they just did some things that most people just do on an everyday basis that actually affected them from getting a financing for a property.
Yeah, I mean, the stuff definitely happens. And what's really hard about it is there's a learning curve, right? There's just, when you go through the process, there's just a lot to absorb, all the terminology, all the different pieces of the puzzle that go into getting a loan. And it's the lender's job to really educate and guide the person through the process. And so it's our job to look at the full picture in terms of credit reports and income and assets, and all the documents, and say, okay, that's something that we need to be able to address ahead of time and potentially make some adjustments and correct before that file ever gets to underwriter. Again, I could go on for hours about talking about things that pop up last second. Like I just had a file today that's in Florida. It's a manufactured house. And like the last thing we were trying to clear is insurance on the house. Well, it's Florida. And we were just talking about this a couple of days ago, last week, about how difficult it is to get insurance in Florida and the company is getting out. And then like it's a manufactured house. So like more of the value is the land versus the actual structure. And then, we typically have to have the dwelling coverage be at least at the loan amount or have replacement cost coverage, which the insurance policy didn't say replacement cost coverage on there, but Florida has its own unique laws that say you don't have to do it. And so this is this whole runaround. And so, but there's so many different things that can actually affect a deal or affect the timing of a deal. But like credit scores, going into a file, there's something that you don't ever want to do, or at least talk to your lender. And, kind of going back to, hey, well, how do I build my scores? One quick thing, hey, the most simple thing that we typically see that can boost somebody's scores is revolving or credit card balances on a card that has a limit that's close. So for example, let's say you have a card that's $1,000 for the limit and the balance is $800. If you have a couple of those where the balance is close to the limit, that can be pulling your scores down. So if you talk to any person in credit, they're going to probably tell you, you want to keep your balances at 30% of the limit at all times. Even if you pay it to zero every month, it doesn't matter because you don't know when the bureaus are going to be taking that snapshot in the month and when the balance is. And so that's just one quick rule of thumb. But if you're in the loan process, let's say everything's going great. And, we see this all the time. We always talk about this. You're getting into a house. What do you typically need to do after you get into the house? Furniture. You need to get furniture. So people may, hey, I want to go shop at the furniture store, get put it on financing in 24 months, and you get a new account that pops up. And now we've got a payment on your ratios. So we'll do a soft pull towards the end of the process. And that soft pull, if there's a new account that's opened, that will come into play in terms of your income ratios, which could kill down. And we've seen it happen before, even though we talk about it all the time. Open a new credit card, new car payment, or furniture, whatever it is. So if you're thinking about opening a new account, talk to your lender, because it may not be a big deal. It just may be an extra piece of documentation work on your end. So talk to your lender.
All right. So now if anybody wanted to reach out, like, remind my guests again, like, I mean, my audience, like, where are you licensed and like, who can you really help? I'm sure if anybody calls you and has questions, you can help them out as far as giving them some feedback, but
Sure.
like, where are you licensed in?
Yeah. So I'm licensed in 23 states. So really just kind of geographically think DC, Virginia, down to Florida, across to Texas, the Midwest. I'm in St. Louis. So, all the Midwest states, California, not Hawaii. Hawaii. I need to get a license in Hawaii.
Yeah.
That's a 2024 thing though. It's coming.
All right. I'm sure you're going to write something off by coming out here.
Mm-hmm. It's a whole tax episode there right there.
Yeah. Well,
Um,
I'm sorry, but I can say, you talked about credit, you're as far as helping that, but as far as income, I know that you're doing other things also that could maybe help people improve their income and getting some side hustles. So that's something else that, they can reach out to you, get some ideas on how to increase their income source.
yeah, I just had a post that I put out today. Today is what, Wednesday, the 26th. And I put something out there today. Hey, if somebody if you had $2,500 and you had 30 days to double that money, and if you double it, cool, you get it. If you don't double it, you get nothing. And people responding and people kind of engaging with some ideas and stuff. And there's a lot of different ways that you can increase income. A lot of different ways that you can generate extra income, whether it be a side hustle, online, social media, coaching. I have a whole list of stuff. And one of the things that somebody mentioned that I absolutely love, and it's something that's so easy to do, in my opinion, in terms of just the barrier to entry is really low, is they mentioned power washing, gutter cleaning, and landscaping. And power washing, like if I was going to choose one of those, power washing versus gutter cleaning, like power washing just has a little bit better, more sizzle to it than gutter cleaning, right? So, and I don't want to get on the ladder. It's not my thing. So I'm like, okay. My mind started going, power washing. People need power washing. If I could just go knock on doors, ask them if they want to power wash something, I go buy a power washer, or maybe even I go buy a few, and I just go out and knock on doors, find the people who need it. And then maybe I go hire somebody, an intern or younger kid that maybe I should do the work, and you kind of leverage your time. Anyway, the reason why I bring that up is an example is from our side of things. When we document income, you have to have a 2-year history of a second job. So if it's part-time or a different business or whatever, you have to have 2 years history of it. So that, we'll get W-2s and we'll get pay stubs. And not only that, if it's a working for an actual company, we'll actually go request a verification of employment. And this is one of the biggest things that comes up that can actually kill a deal, because we have to verify work dates and gaps in employment to complete the file for underwriting. And so if we can't get a hold of a company to confirm dates, whether it be verbal or written, that could be a problem. We have to, kind of all hands on deck, figure out how to do it. So that's something to be aware of. So let's say that you have a side job at whatever company that you're at, and you've only been there for 1 year. Odds are we're probably not going to be able to use it. However, the money that you're getting from that job, putting in the savings, well, cool. We'll obviously use that. And so even if you're just starting out something, recently, and you can't use it for a loan, okay, cool. Stockpile some cash, because as we talked about before on the stair-step method, you get into a property, maybe it's not your forever house. Maybe you live there for a year or two, and then you work up and you save more money to buy the next one and just like upgrade, turn the old one to rental. But by that time, you'll have your 2-year history of working the second job, and maybe you can qualify for higher.
But it'll also help you from showing, like you're saying, a reserve amount, right? So if you, like you're saying, stockpile that money to show the lender that you have certain amount of reserves.
Yeah, I mean the biggest limiting factor, and this is something that I say all the time, the biggest limiting factor for people getting into real estate, no matter how much they want to get in, is having enough money for down payment and closing. That's the biggest limiting factor. And so, saving money on your own is obviously one way. Borrowing from a 401k or retirement account is another way that's acceptable. A gift of funds from family is acceptable. Mom, dad, cousin, brother, cousin is an important one to be aware of. And then the question is, okay, it's a gift, not a loan. So we're going to document. The gift letter will say, hey, this is a gift, not a loan. So that's something that is important to be aware of. And we're also going to be getting that donor's bank statement, which sometimes grandma, Susie, aunt, whoever doesn't want to do that.
Yeah.
And so that's something to be aware of.
All right, man. This has been awesome information. Again, I'm sure somebody got some useful information from this, especially like the credit side. Like I said, when I got my first residence, I had no clue about any of this. And like we talked about, this is not something you learn in school. It's not taught. And I think that's very unfortunate because it puts people in bad situations, I think, because they just don't know how money works and they don't know how their credit score is going to impact them from purchasing a home down the road.
Totally.
All right. Well, we'll do this again next week and we'll figure out a different topic to come up with. But thanks again for joining me. And I'll talk to you next week, Joel.
All right. Thanks, Mark. Bye.